statement. It's a nice little reading, quite short. Okay, so since, particularly post-Enron, there's been an increased focus on cash flow statements. The logic being cash flow is much more difficult to manipulate than earnings. Now, of course, we need to get rid of the misconception that you cannot manipulate your cash flow from operations. Remember, CFO is going to be the most important cash flow because it's the cash that you are generating from your day-to-day trading activities. So as a result, analysts look at CFO as being the sustainable cash that the company can generate. Now, the misconception is CFO cannot be manipulated. Reality is, of course, it's difficult to manipulate the total change in cash, i.e. CFO plus CFI plus CFF. Very difficult to manipulate those because it's so easy to audit. All the auditors need to do is look at your cash in your bank account last year, cash in your bank account this year, and look at the change. So very, very difficult to manipulate. What the company can do, of course, is manipulate between the classifications, i.e. manipulate between CFO, CFI and CFF. And the idea here is we're going to want to boost our CFO, maybe at the expense of CFI and CFF. So remember, CFO is going to be so important because it forms the basis of things like free cash flow. And of course, free cash flow is used in equity valuation models. So our LOS here asks us to analyse and discuss the motivations for cash flow manipulation. So why might we want to overstate our cash flow from operations? Well, of course, if you overstate your cash flow from operations, analysts will perceive higher sustainable cash, higher free cash flows, a higher equity valuation. So you should get a higher share price from increasing people's expectations of higher free cash flows. Now, of course, as well, CFO is used to pay off both interest and principal on your debt. So the bigger your CFO is, the bigger the sustainable cash flow from operations is from period to period, the easier you're going to be deemed to pay off your interest and principal, and as a result, you're going to achieve a better credit rating, and if you achieve a better credit rating, the costs of borrowing are going to be lower. And of course, the final point here says, well, often directors' incentives, incentive compensation, i.e. bonuses, are linked essentially to cash flow from operations. So therefore, again, if you're going to get a bonus based on CFO, there's a motivation to overstate CFO. Okay, so let's have a look at some of our methods, maybe, of boosting CFO. Delaying payment to suppliers. Of course, when we pay our accounts payable, we know the cash flow goes through our cash flow from operations. So if you pay your suppliers, CFO goes down. So if you delay paying your suppliers, of course, you keep your CFO as a higher figure. Now, of course, there are two views when we look at this. If suddenly we start delaying payment to suppliers, it could indicate that the company is struggling with cash generation, i.e. it just simply does not have the cash to pay the suppliers. And of course, that would be a negative opinion on the company. The other view, of course, could be that the company is utilising a prudent cash management strategy, i.e. the delay in payment to suppliers is not because we lack cash, but it's a deliberate strategy, essentially, to improve our cash operating cycle. Now, from the analyst's point of view, you should be aware that if you delay payment to suppliers, you're going to get a one-off boost to your cash flow from operations. In other words, it's not sustainable. You would continually need to increase your payment terms if you wanted to boost CFO. So a one-off increase in your payment terms isn't essentially sustainable in the long run. And of course, the very big risk is if you've essentially delayed payment to suppliers without those suppliers' permission, then of course they may reduce your credit in the future. As a result, CFO would actually be lower in the future because we'd have to pay our suppliers more quickly. One thing to do to actually spot us delaying payment to suppliers is to review our days sales payable. So remember how we do this. We look at our average accounts payable over purchases times 365, or if you like, 365 divided by accounts payable turnover. Again, that gives us the number of days, if you remember, that we're taking to pay our suppliers. So again, if that increases from year to year, you'd think, oh, well, okay, we're delaying payment to suppliers. That's going to boost our CFO, but it isn't sustainable. Now, this is a little bit of a weird one. Financing of payables. So what this is the idea that you may borrow in the short run and use those borrowings to pay off your accounts payable. Now, of course, if you do that and you borrow, the cash coming in from the borrowing is going to go through CFF, so you get a boost to CFF. But when you pay off your accounts payable with that cash, it's going to decrease your CFO. So the point here is we could use this to manipulate the timing of our CFO. So you can see what we're going to do is borrow from a financial institution and use that to make a payment to the supplier. At that time, we're going to reclassify our accounts payable to notes payable. So CFO goes down, CFF goes up. Why might we want to do this if it's going to reduce CFO? Well, what it's doing is it's accelerating the payments to our suppliers. And therefore, what we might want to do is do this in a period where our cash flow from operations is very strong. Okay, so in other words, what we're doing is we're reducing CFO now at the expense of having a greater CFO in the future. Because finally, when we pay off our short-term borrowings, that's going to reduce our CFF, not our CFO. So essentially, you're manipulating between CFF and CFO in the short run. You're reducing CFO now, and therefore you'll have a higher CFO in the future. Our next point is the securitization of accounts receivable. Remember, this is selling off our accounts receivable or notes receivable to either a financing company or a variable interest entity, a special purpose vehicle. What's the difference between notes receivable and accounts receivable? Notes receivable are interest-bearing, accounts receivable are not. Okay, now of course, if we sell them to a finance company or VIE, what's going to happen is we're going to see a reduction in our balance sheet notes receivable or accounts receivable, which is going to essentially go through our CFO, okay, and we're going to have an income statement impact as well. Notice essentially if you sell off your notes receivable, you may well show a profit in the income statement. Why? Because the cash received is often bigger than the face value of your notes receivable in the balance sheet. Why might that be the case? Why would somebody pay more than the face value of notes receivable? Well, of course, remember, notes receivable accrue interest, okay, so which is not shown in the face value. So you might get a gain, essentially, if you sell off notes receivable. Accounts receivable, well, typically a factoring company, a finance company, or a VIE is going to pay less than their face value, and as a result, typically will show a loss in the income statement when we sell those. Okay, so what's happening is it's essentially accelerating the cash collection from our accounts receivable. When we sell off our accounts receivable, it's going to reduce our accounts receivable and as a result give us a boost to our cash flow from operations. It's as if we've collected the cash from our customers that much quicker. Tax benefits from stock options. Well, there's going to be a tax benefit when employee stock options are exercised, and to work out the tax benefit, we look at the number of shares essentially created times the market price at the date the shares are exercised compared to the exercise price. And you then multiply that by the tax rate, and that gives you your tax savings. Now, of course, we know, especially under US GAAP, tax goes through CFO. So if this is going to reduce your tax, lower tax gives you a boost to CFO. But again, remember, it is unsustainable. Okay, so we only get a boost to our CFO when these options are exercised. And then our final one is looking at share buybacks to offset dilution. So again, this is talking about employee stock options. Now, when employee stock options are exercised, we know new shares are created. And when we were looking at EPS, we saw that that essentially new shares created are going to create a reduction in your earnings per share. So what you often will find is a company moves into the marketplace and repurchases shares, i.e. buys back shares, before employee stock options are exercised to offset dilution. So it's dilution of earnings per share, but it's also dilution of voting. So we've got a share repurchase here of $24,000 compared to the proceeds that we'll receive when the employee stock options are exercised of $20,000, giving us a net cash outflow of $4,000. Well, we know the accountants will put the share repurchase and the proceeds from the employee stock options through our cash flow from financing. So overall, essentially, cash flow from financing would be $4,000 lower. We, the analyst, actually believe that this is part of meeting your employees' compensation, i.e. it should be included as part of their salaries. And if their salaries go through cash flow from operations, this net cash outflow should go through cash flow from operations as well. So we'd increase CFF by $4,000 and we'd take the $4,000 through our CFO, reducing our CFO instead.